how do you incorporate the beta?
What do you mean? I'm not sure.
So I'm just thinking about, you've got your chart, you've got all of these markets that do well in a, you want to be in fixed income, and these are the markets that are, or let's say you want to be in equities.
Mm-hmm.
How does the beta ranking kick in terms of the assets that you want to hold in the portfolio? I mean, I understand it's sort of like above that line, but it seems like by just using that line, you're actually eliminating that covariance, that or like market beta dimension entirely. So I'm just wondering kind of how that feeds into the process, or how you think about that.
Yeah, so that's exactly the point. So if I don't have the reflation or Goldilocks scatter plots in here, but do you mind? Let me share one more time.
Yeah, go for it.
Yeah, I don't have
I'm on it.
So looking at equities in particular. So you want more beta in Goldilocks and reflation. So for example, if I'm in equities, if this was Goldilocks, for example, there'll be a lot of dots scattered up here. You know what I mean? It'll be like high beta, the Qs, tech, industrials, energy, financials. You actually want that beta, because it's going to give you that beta, that volatility is actually a positive feature in that regime. You're getting more return, for per unit of your risk. However, as you notice, all the highest dots in these two risk off regimes, and the regimes where growth is decelerating, all the highest dots are where you take the least amount of risk. And so that to your point, Adam, that's a great question. It's like, how do you know how much beta to take or where to get the beta from? It's a function of what regime you're in. When you're in inflation and deflation, you want to be congregated to the upper left. Generally, you want to be congregated to the upper left at most of the time. But the reality is there are no free lunches in markets. You're not always going to get a lot of dots in the upper left, right? Typically, what you're going to see is dots up here and dots down here. Risk, the risk tends to correlate with the reward. But there are times what this process allows investors to do, I think, at a really high level, is understand the anomalies in terms of the risk and reward you're taking, both to the upside, obviously, for something like healthcare, but also to the downside for something like high beta.
Okay, so these plots are meant to be sort of a visual to help investors to understand that by virtue of being in a deflationary regime, all of the assets that you want to emphasize tend to be lower beta.
Yeah.
And if you're really, so it's the beta is not really, you're not really using that to select the assets so much as to illustrate that we want to be in low beta assets, and we're selecting these assets.
Yeah, exactly. Now, if all like this circle that I'm circling here, if this circle was transposed down here, that would not be true, right?
Yeah, because they would have low expectancy.
It would have low reward. Exactly. So
like you said, I mean, the Sharpe ratios of any one of these strategies, any one of these securities change over time.
Mm-hmm.
Right now, the highest Sharpe ratio is in the top left here, right?
Yeah, exactly.
And that may not be the case. Even though you might be selecting more volatile asset classes, the return might be so much higher that the Sharpe ratio for that moment is expected to be higher.
Yeah, you're absolutely.
And that's how you manage that.
You're spot on. That's exactly it.